Every year, over 1 million early-stage founders try to raise capital to scale their business by selling equity to investors, but very few succeed. Hi, I'm Ian, co-founder of Focus15, and today I'd like to talk about options when raising equity investment and what they mean for your business. People generally talk about three main sources of capital for startups: family and friends, angel investors, and venture capital. Now, I've sat in more meetings than you can shake a stick at with VCs and advisors who point to family and friends as your first port of call for raising funds. Personally, I think that's a bit of a cop-out. Suggesting that family and friends take the risk before supposed professional investors is a bit arrogant, really. And some people simply don't have the family and friends with the sort of finances available to give that level of support. But if you do, then by all means consider it as an option. It worked for Jeff Bezos, it worked for Mark Zuckerberg, but be mindful of the implications. If your business works, everybody's happy. But what if it doesn't? What sacrifices are you asking your family and friends to make in order to help you? Is it money they can afford to lose, or are they risking everything for you? And can you live with that responsibility? And if you do go down that road, make sure you have a signed contract. It won't just be important for family and friends, but also if you choose to raise investment further down the line, it will also be needed at that stage. Angel investors are typically high net worth individuals investing their own money in early stage companies. Most operate through angel investment groups, syndicates, or crowdfunding platforms, and in advance they've confirmed their high wealth status and understanding of the risks involved. Now, they can invest anything from tens of pounds to tens, if not hundreds of thousands of pounds. They tend to have a slightly different outlook from VCs. Most are looking for SEIS and EIS approved opportunities so that they can reduce the risk by offsetting income tax, and many look for investments in a sector they're familiar with or have experience in because it obviously gives them confidence. And that can also be good for founders because it gives a route to some expertise. They're generally looking for good returns, but not necessarily unicorns like VCs, and building trust with founders is really important. Angel groups operate in different ways with regard to fees. Usually they involve a combination of upfront application or pitch preparation fees, completion fees, or success fees. I personally be a little bit wary of the upfront fees because the chances of success are still very low. Only less than 1% of applications end up getting funding. So it's really important to understand the terms and what you get in return. For example, how many times can you pitch and what's their track record for investment like? Crowdfunding platforms can be useful, especially for consumer-centric products. Fee structures vary across the different platforms. Many involve upfront fees. All of them include success fees, some of which can be quite high. The problem with this route is that you already need to have quite a large percentage of your round covered before you start. They tend to work crowdfunding sites on FOMO, so people invest if they say other people invest in. And whilst pre-launch commitment percentages aren't actually stated anywhere, the unwritten rule appears to be over 50%, and the higher the better. So whilst you get access to a pool of investors who are actively seeking opportunities and who could potentially act as brand ambassadors in the future, which is great, you're having to do quite a lot of the heavy lifting in advance. But it can work, especially if you do it in conjunction with another method. So say you do part angel groups to give you that initial commitment and then crowdfunding to top it off. Then we come to venture capitalists. They manage funds from a pool of investors. They are institutional players who have a responsibility to make a return for their investors. Every fund is slightly different. Some focus on stages, so pre-seed, seed, Series A, and so on. Some focus on particular sectors or service models. Some focus on founder characteristics such as female or underrepresented founders. Most tend to adopt a unicorn hunting type approach or model where approximately 70% of their investments fail, 20% make a small return, 8% make a solid return of say 2 to 5 times multiples, and then 2% are big winners. So their model relies on the big winners to offset the others, which then dictates the type of businesses they're interested in. And that's why only around 0.05% of founders who apply to VCs are successful. VCs tend not to charge founders up front, but can impose quite onerous terms that push hard for growth. And research suggests that around 50% of founders actually regret raising VC funding because of all the strings that came with it. The process for raising from VCs or angel groups is very similar, and it's pretty inefficient if you ask me. more or less everybody involved. The first thing to consider though is timing. There's no point in applying for funding before you're ready. Now you'll probably hear a lot of people promising to help you get investor ready, which often means perfecting your pitch deck and presentation skills. That's not what I'm talking about. When I say ready, I mean applying at the right time, when you have the right elements in place to increase your chances of success. Fundraising is ridiculously time consuming for founders. TechCrunch suggests that pre-seed rounds typically take around 6 months and consume over 400 hours of founder time per raise. So the question you need to ask is, do I spend 40% of my time over the next 6 months improving my business, or do I spend it chasing finance that I've got a very low chance of getting? So only apply when you've given yourself the absolute best chance of success. And our growth map technology helps identify and work towards that moment based upon what investors are looking for. Under the current system, which is something we're hoping to change, you'll then need a compelling pitch deck to give you, the investor, a sense of basically who you are, what problems you're solving, where you're going to end up, what's the opportunity, and why would someone buy from you, and why would an investor invest? Now, everybody you speak with will have an opinion, and a different opinion on your pitch deck. And I'm not going to tell you how to write one. There are plenty of services out there who can do that for you, but you're wasting your time and possibly your money trying to chase the perfect deck. It's impossible. Yes, you can have a better deck, but there is no deck that is going to please all of the investors all of the time. But the most important thing you need to remember when doing one is that investors see hundreds of pitch decks every week, and you have less than 1 minute to make an impact. So your opening slide needs to hook investors to get them to read more. You need clear and concise answers to those upfront questions, and remember, the pitch deck is simply to get you the meeting, nothing more, so you don't have to go into endless detail about how your business operates. Then it's about trying to get in front of the right people. So do some research first. There's no point in sending off your B2C deck to an investor who's only interested in B2B. But once you have a list of possibilities, then you need to get your deck in front of them, and it's incredibly difficult. You can research the investment associates and try to connect with them on LinkedIn, but research suggests that the response rates are less than 1%. And when I'm talking about response rate, I'm not talking about arranging a meeting, I'm just talking about acknowledging that you've sent something in the first place. It's slightly higher with a more personalised message, but not much. If you can find an email address for the associate, great, but that's not easy. You're then looking at around 10% response rate with a personalised email and a pitch deck attached. I wouldn't personally bother with the general office email. That seems to me to be a complete waste of time. I don't actually know why VCs put general office emails on their website, because you never get a response from them. Submission portals for VCs offer a response rate that average around 2%, which personally I find really frustrating. If you advertise submissions, then it's just common courtesy to get back to applicants, or make it more clear what you're interested in up front so they don't apply. To be fair to angel groups, their response rates do tend to be slightly higher. A relatively new phenomenon to hit the startup streets recently are pitching and award events being advertised as an opportunity to connect with investors. The better ones offer a 4-to-1 sort of founder to investor ratio, so it can be a bit like bees around a honey pot. They can also be quite time consuming for founders, and after a while you'll realise you're seeing the same faces on the circuit all the time. By a country mile, the best route is a warm introduction. I go so far as to say, from a strategic point of view, they are the only way. The other options have such poor time-benefit ratios, you're relying on luck more than anything else. And that's why we spend time at Focus15 developing relationships with VCs and angel groups, so that we can help match the right businesses with the right investors at the right time. If you're invited to pitch, it's important to realise that it's a two-way interview. Yes, the VCs are interviewing you to understand your business, and more importantly, you as an individual. They want to know what drives you, what makes you different, whether you can, work with them. But at the same time, you should also be trying to understand them. How will they support you? What success looks like to them? What happens when things go pear-shaped? Can you work with them? The most important thing is to be yourself. You don't want to get into a long-term relationship where you pretend to be somebody else on the first date. It's just not worth it. And if you need support on your journey to raising investment, we're happy to help. But whichever route you choose, good luck. Thanks for listening. If you found this useful, hit subscribe, drop a comment, or get in touch at focus15.co.uk. And in the meantime, stay focused, and we'll see you in the next one.